Costco is arguably the best brick-and-mortar retailer in the world, and the stock price has already performed phenomenally well over the last few years and the last few decades, to be sure. But where could Costco's stock price end up by the end of this year? That's the question I'm going to look at in this video, analyzing Costco's financials and determining where I think the stock price could end up. So let's jump in, let's dig into the details, let's see where this world-class retailer could end up by the end of the year.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
The numbers I'm going to need is Costco's current stock price, which is trading at $704 per share. I mentioned that it has performed exceptionally well. You could see that stock price increase for yourself over the last 1 year period. And if I zoom out the last 3 year period, you can still see the upward trend. And if I go even longer for the last 10 years, you can see Costco's stock price is just an excellent performer. It's growing as if it was a tech stock. Some tech stocks haven't even increased in valuation as much as Costco's stock price has in the last decade. So the company's firing on all cylinders. Everything seems to be going right. So let's see where the stock price could end up by the end of this year. So another one of the estimates I'm going to need is its forward price to earnings ratio. It's currently trading at a forward PE of 41.42. So not only is Costco's stock price increased, but its valuation has increased. Those two are different things. So let's take a look at the importance of the price to earnings ratio. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. Okay, so now that you understand how it's different from the market price, you can see that Costco's stock is more expensive than it's been. It's trading at a forward PE of 41.42, the highest price it has traded for going all the way back to mid 2021. So this is something to keep in mind. There is little room for this valuation to increase going forward. The other thing I'm going to need is Costco's earnings per share estimates. Now, analysts on Wall Street think that Costco is going to deliver $15.75 in earnings per share in 2024, and that's going to grow to $17.11 in 2025, followed by further increase to $18.97 in 2026. These are fiscal years for Costco, which end in August for Costco. I know it's confusing, but many companies have fiscal years that are different from the calendar year. And that's why you have years like this, fiscal years like this, which end on August instead of in December. So the earnings per share we're going to use is for 2025 because we're using the forward price to earnings ratio. And so if we're using the forward price to earnings ratio, we need the earnings per share for 1 year ahead for the year we're trying to get the estimate for. So we're trying to get the estimate for 2024. So we need 2025 earnings per share estimates to make that stock price prediction. So if Costco delivers or is on pace to deliver $17.11 in earnings per share in 2025, as Wall Street analysts forecast, and its price to earnings ratio stays the same at 41, then the stock price could reach $701 per share. Now, if you look at where it's at now, $704, that would actually be a decrease. So maintaining its premium valuation and increasing its earnings per share will actually lead to Costco's stock price falling. Interesting. If its forward PE falls to 35, to a much more average ratio according to its historical valuation here, then the stock price could fall to $598.85. If the forward PE were to fall to 32, the stock price could fall to $547. Still lower, if the forward PE falls to 28, its stock price could fall to $479 by the end of the year. So a lot of downside here for Costco stock, and that's understandable given how fast and how strongly the company has increased its earnings, its sales, its profitability. I mentioned it's firing on all cylinders. And is there a mean reversion coming for Costco? Is it going to revert back to the norm? I would argue not in the business. If you look at Costco, one of the main factors I look at when I'm judging a brick and mortar retailer is the inventory turnover ratio. It demonstrates to me how good a company is at securing the type of products that their customers want and securing them at a price to be able to sell them to their customers at a price above what they pay and generate a profit. And so the inventory turnover ratio, for me, it's one of the most important metrics to rank brick and mortar retailers. And if you look here, I've got some world-class retailers: Costco, Walmart, Target, Home Depot, which in my opinion is an excellent retailer, especially given that it operates in the home improvement industry. If you look at the inventory turnover for these world-class retailers in the last decade, you can see Costco stands out. It's held the lead by a wide margin for the whole decade. 14.34 inventory turnover ratio, miles ahead of Walmart at 10.69, which is the second best, and nearly twice the rate of Target at 7.565, and trouncing Home Depot at 6.297. The company has earned its premium valuation, to be sure. Costco is, like I said in the beginning of the video, arguably the best brick and mortar retailer in the world. Still, it's a brick and mortar retailer with very thin profit margins. Still, and limited growth prospects because it's difficult to expand if you're a brick and mortar retailer. So, does it deserve a premium valuation, of forward price to earnings of 41? A forward price to earnings of 41, that's an expensive valuation. I mean, if I were to add Amazon to this mix here, you could see Costco is actually trading at a forward price to earnings ratio that's more expensive than Amazon. More expensive than Amazon. Not only is it more expensive relative to itself, it's already trading at its own highest valuation it's traded for, but it's also more expensive than the giant Amazon and many, many other companies. So I can understand that there is some downside risk to Costco stock. However, I have been saying this about Costco for a little over a year, year and a half, I think, in that I've felt that the stock is overvalued with little upside. And if you look at where the stock price has gone in the last year, year and a half, I've been tremendously wrong on this stock. Look at that upward trend. I think around here is when I started suggesting that Costco stock is overvalued. And I've always admitted that it's the best retailer, arguably the best retailer, but I've just been hung up on the valuation, and it's not worked well for me. So these predictions, I would say the more realistic, the most probable outcome for Costco stock by the end of the year is somewhere in the range of $675 per share and $725 per share. Again, though, remember, I've been wrong on Costco stock for a year and a half now. So take this recommendation with a grain of salt. It's been one of the stocks that I've gotten wrong consistently for the last 18 months. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.